Welcome to your presentation on bottom-up pricing. So what is bottom-up pricing? Bottom-up pricing, it's also known as Hubbard formula. It's an approach that we can take to discover what revenues are required to reach a firm's financial goals. So it's literally a backwards way of approaching our forecast. So to figure out how much revenues we need in order to achieve a set goal. Now those two goals could be either return on investment, an ROI percentage, or an income after tax amount, or what we also refer to as net income. A return on investment percentage would be, let's say I invested $100,000 and I wanted a 10% return on my investment. You would simply multiply the two together to find out the answer. So like I mentioned, we start from the bottom line of the income statement and we work our way up to find out what revenues we need to make in order to reach that goal. Okay? So it's used by both restaurants and hotels. Some of the key math that we need to know is we need to figure out our income before tax equals income after tax divided by 1 minus tax rate. This line right here, our upper one, we won't need to know as much, but our income before tax we'll want to know for sure as we move forward with this with bottom-up pricing. Another one that you're going to want to know is that revenues equals income before tax plus fixed expenses plus variable expenses. If we think back to the income statement calculation, it's revenues minus expenses equals income. So now all we've done, if you take a look at this equation, is we've brought our expenses and we've put them onto the other side of the equal sign, right? So we've transferred them over, so we had to add them back. So that's all. We've just rearranged our income statement formula to be revenues equals income before tax plus our expenses. Now we will most likely be using a percentage for variable expenses because variable expenses fluctuate with sales. So we're actually going to use more of a percentage here. This will become clearer as we go through an example. So the bottom-up process, what are the steps? First step is to determine the desired net income after tax. So what is the goal? What kind of profit do I want to make? Once we've done that, we can calculate our pre-tax income and then check our tax calculation. Throughout the bottom-up process, as you'll see in an example later, we must always check our math to make sure that we are doing things properly. Then we want to do the math to calculate the required revenues. And that's our last step once we've determined our variable cost percentage. So an example, let's say I want to achieve $75,000 in profit, my income after tax, that's my IAT, with fixed costs of $20,000, and I normally have a variable cost percentage of 15%. So let's walk through. Step one, what's my goal? My goal is an income after tax is $75,000. My step number two is going to be to calculate my income before tax, which I go, and this is the calculation that we spoke about before. To find out my income before tax, I'm going my income after tax divided by 1 minus the tax percentage. In this case, it's 10%, so we'd go 1 minus 0.1, which is the same way of writing 10%. Now, why do we do this? If you add these two numbers together, okay, whatever the income after taxes and the amount of tax, they'll equal this number. Okay? Therefore, these two numbers are a percentage of this entire number. Okay? So if the tax is 10%, the income after tax must be 90% of this number. Therefore, we divide income after tax by 90% to find out what the income before tax would be. Then we would check our tax. Okay, so once we find out our income before tax, we will always check our math. So we'd go our income after tax equals income before tax, because we've just discovered, minus income before tax times the tax rate. So whatever we're paying in taxes, it should equal back to this $75,000. And that's all we're doing there. We're just confirming. We know that it should be $75,000, but we are confirming that. We want to determine our variable cost percentage, which is 15%, and then we need to do the math. Doing the math would be to go our income before tax plus our fixed cost plus our variable cost percentage. it's hard to add a variable cost percentage. So what we end up doing is we go our known dollars, our known amount in dollars. In this case, we would know our income before tax and we would know our fixed cost because it's given. And we divide by 1 minus the known percentage, which is our 15%. So in this case, it would be our income before tax plus fixed cost of 20,000 divided by 1 minus 15%. Okay. So if you have more than one variable cost and more than one fixed expense, in either case you need to add them up. So if there's two variable costs that have two different variable cost percentage, you need to add them up before you move forward with your bottom-up approach. For fixed expenses, you need to add them up before you've moved forward with finding out your required revenue. You have to do this first. So now let's make this a bit clearer by going through a restaurant bottom-up example. So we've talked about how menu pricing can be set by a cost percentage approach, by a contribution margin approach. We talked about the cost factor. We could also go ahead and use the bottom-up approach to figure out what we need to make, what our required revenues are, to then figure out an average check. So restaurant pricing using bottom-up, we follow the same bottom-up steps, but then we use the required revenue to discover our average check and also an average check by meal period. Okay. Before we go through an example, average check, the calculation in this case is going to be our total annual sales. In this case, it's really required revenues, right? So it's going to be our required revenues divided by how many seats we have in a restaurant times how many times they turn over per day times how many operating days we have. Okay. Our seats times our turnover means how many times each seat has been used. That's another way of saying how many covers, right? And then multiplied by operating days, and that gives us for the whole year. So if we figure out our required revenues for the year and we figure out how many covers we believe we're going to serve, we can find out our average check that's required in order to meet that goal. And then we have an average check by meal period. So meal period sales percentage revenue. So in this case, we're going to break it down by the different meal periods the restaurant offers. So breakfast, lunch, and dinner. Each dinner period, each meal period is going to have a different percentage of sales that it brings in. It's also going to have a different type of turnover. So you might turn over seats more during breakfast than at dinner. You might have more revenue coming in at breakfast compared to dinner. There could be a number of things that happen there. So we need to be able to take a look at each meal period, because an average check for the entire year won't really help your pricing for individual meal periods. So let's go through an example here, and this is going to be a restaurant example. So at first I want to just go over a simple bottom-up approach. So I'll just, first of all, let's make this bigger so you can see a bit better, and I'll zoom in a bit just to this example. Okay, so on the right hand side you'll see the steps. We could also, but we're just going to go through them. It's good to review these, it's good to study them so that you definitely know them before going into any assignment or any test. So in this example, 2016 would be historical information. Okay, so this would be information that we know about 2016. Now what we're trying to do is we're trying to set our forecast, set a goal for 2017, and then discover how much money we need to make in order to reach our goal. So we're really going from the bottom up instead of the top to bottom. Okay? So the after tax net income goal for 2017 is $35,000. Complete all the shaded cells. So step one, do we know our net income after tax? And this we could also just write our IAT, right? It's the same thing, income after tax. So do we know it? Yes, we just got told $35,000. Okay. Now we can't figure out our taxes just yet, but what we can find out is our operating income, which is the same as saying our income before tax. Okay. So we know that our tax rate is 20%. So if you review the earlier part of this presentation, you'll remember that to find out our income before tax, we have to go our income after tax divided by 1 minus the tax rate. Now, The reason being is if I were to add on my income after tax and my taxes, I should equal this number. Therefore, these two are just percentages of this entire number. That's how to think about it. So if we do this, and I'll write it out in the cell, we would go our $35,000 and we would divide it by, and we want to make sure we use bed mass here. If we don't use bed mass, it's not going to work. So we're going to divide by 1 minus 0.2 because our 20% tax rate, we're writing it as 0.2. Okay. So $43,750 is what I need to make in income before tax or operating income in order to make this profit, this income after tax, after taxes. Okay. So how can we make sure we've done this properly? Well, we can multiply 43,750, which is, you can't see right now, our new operating income for 2017, what we need to make, okay, times our 0.2, which is our tax rate. And now to confirm again that we've done everything properly, we can go our income before tax minus our taxes. And if we've done this properly, minus our 8,750, if we've done this properly, and sorry, if we've done this properly, and we go $43,750 minus $8,750, we should have the same net income after tax. So that's a great start. Now, in this case, there's no cost of sales. We'll get to an example that's a bit harder in a second. But really, gross margin is just going to be like gross profit. It's revenues minus cost of sales equals gross margin. So our required revenues and our gross margin will be the same in this case. We do have variable expenses. So I haven't given you a variable cost percentage forecasted one for this year. So what we'll do is we'll use the historical information to then forecast what the variable expenses will be for 2017. So in this case, variable expenses were $5,500, and if I want to know what they were as a percentage of total revenues, this should take you right back to your common size analysis. We'd simply divide it by the revenues to find out that in this case it was 10%. So last year we had 10% variable expenses. We're going to use that this year as well. Okay. Now if you go back to the presentation, rewind a bit again, you would see that to find out our required revenues, we have to go our income before tax plus fixed expenses, and then we're going to divide it by 1 minus the variance, the variable expense percentage. So in this case, let's do that again. So revenue, we would just write revenue equals, open brackets, income before tax plus fixed costs, close brackets, divided by, open brackets, 1 minus our variable cost percentage. Okay, and this is the math we're going to do. Again, if we add up our income plus our expenses, all of our expenses, we should get our revenue, okay, which is a 100%. So these three lines in our income statement equal this 100%. So they're all a percentage of this number. If I know that variable costs are 10%, that means that these two combined equal 90% of this number. Okay? So if I want to know what the whole number is, if this is 90%, we divide these two by 90%. So in order to go, we'll shoot right up to required revenue. We would open up our brackets and go 43,750 plus our fixed costs. And we divided that by, open our brackets again, 1 minus, and in this case we said 10% for variable costs. Okay, so 0.1 is our 10% variable costs. So our required revenue, in order to make this type of profit, we need to make $59,722 in revenues. And that's how you would read it. So $59,722 for our gross margin. And then again, we just want to redo the math. So we said 10% of our required revenues are going to be variable expenses. So let's take our required revenues times our 10%. That's all we're doing. Now, if everything has been done properly, we should be able to go to our gross margin minus our variable expenses minus our fixed expenses should give us our operating income. So $59,722 minus $5,972, minus 10,000. And with any luck, yeah, we should have the exact same number. So that's to make sure. We're just confirming. So how do we read this? The way to read this is, in order to have a profit, a net income of $35,000, I need to make $59,722 in revenue. Okay, and that's how we would read that. In order to reach this profit goal, I have to make this much money. Now, we would also want to do the same for this example right here. You can look to answer these questions. It should be fairly straightforward for those ones. For our 2017 in this example, and let's make this a bit bigger, you'll notice that we have numerous variable expenses, numerous fixed expenses. So let's go through this. So our tax goal, our net income after tax goal is $125,000. That's step one. Now we have our tax rate, which is 32%. So again, we're going to go our income after tax, and we're going to divide it by 1 minus the tax rate, 0.32. So if these two, and my net income after tax and my taxes, equals my operating income, my income before tax, that means that this number is 68%, okay, of this number. So that's what we're doing. We're dividing it by 68% to find out what the whole number is. So $183,824. And then let's confirm it. We would go our $183,824, our income before tax, and we multiply it by 0.32. Okay? And that would give us our taxes. So to confirm, let's go our income before tax minus our taxes. And with any luck, we should have the same number. And that's just to confirm everything's been done properly. Now in this case, this is where it gets a bit trickier. We have cost of sales. That's food and beverage, right? Therefore, that is a variable expense. So we have to find out our variable cost percentage for cost of sales, our variable cost percentage for variable expense number 1, and our variable cost percentage for variable expense number 2. Okay? So we'll do that for historically for 2016. So in this case, we could just go $12,300 divided by, and all I'm doing is dividing my variable expense number 2 by my revenues, okay, from 2016. So that was 5%. Then I need to find out variable expense number 1, so $36,900 divided by $246,000. And that's 15% of that number. And then $49,200 divided by $246,000. Okay. If I were to make these all into percentages, these are the percentages that these variable expenses were of total revenues last year, and that's what I'm going to use this year. So now that I have my income before tax and my fixed expenses, I can move towards discovering my required revenues because I also have my variable cost percentage. So in this case, we need to start off by adding up some things. Okay, so we need to add up all three of these percentages. If we do that, we should see that we have 40% of total revenues is going to be our variable cost percentage. That means that our fixed expenses and our operating income should equal 1 minus this number. Okay. So what we'll do is we'll go and we'll open up our brackets, our operating income or income before tax, plus our $12,000 for fixed expense 2 and our $25,000 for fixed expense 1. And we're going to divide that by, open your brackets, 1 minus the total variable cost percentage of all of them. In this case, it's 0.4. We discovered that. Okay, 40%. That should give us our new required revenues. Okay, and then we can start to fill in everything. So $368,040 is my required revenues, and I need to multiply that by my cost of sales percentage, which is 0.2. To find out my gross margin, that's my gross profit, I can just go my revenues minus my cost of sales. Okay. Then for my variable expense 1, it's going to be my total revenues again. Remember, it's that common number, common size analysis. We're going to multiply by 0.15 because variable expense 1 is 15% of total revenues. And then we're going to multiply again my total revenues times the 5% for this variable expense. So now we have all of our lines. This looks more like an income statement, but let's make sure we did everything properly. We can move from gross margin in this case and move down. So we want to get to operating income from gross profit. So we would go our gross profit, our $294,432 minus variable expense 1 minus 18,402, which is variable expense 2, minus my fixed expenses and minus my fixed expense number 2. If I've done this properly, because we're just doing the same math we would to find out my income before tax, okay, should press enter and I should have this number right here. Phew. So this is good news. This means that we've done this properly. So what does it mean? And that's the big thing. Okay, the math is going to be a lot of the part that we really need to make sure we understand, but we then need to be able to analyze this and explain it mostly. Okay, so this is my goal for 2017, my $125,000 profit. In order to do that, okay, in order to reach this goal with these fixed costs, and if my variable cost percentages are consistent and they stay the same, to make this type of profit, I need to have $368,000 worth of sales. And that's how to communicate that. Okay, so in order to make my profit goal, my net income goal after tax, I need to make this much in revenue. So that's what you need to really understand, the connection from one point to the other. Okay. Now, once we have a required revenue, okay, a revenue requirement that we've decided on, okay, or that we've calculated, now we can start to look more into an average check. Okay. So, for this example, we're going to go through two different aspects to it. An overall average check, and then we're going to go through one for meal periods. It's going to be the same example, just with one being just overall and one being average check per meal period. So if we go back to our slides or right here, you'll see that we need to calculate this by going total annual sales, in brackets total revenues. In this case, it's my revenue requirement divided by how many seats times the seat turnover times operating days. So in this case, it's going to be my $1,512,356, and I'm going to divide that by, and we'll just open up our brackets to make sure we do this calculation first, 20, okay, which is the number of seats in our restaurant multiplied by how many times these seats turn over. So these turn over 15 times a day times operating days in a year. Okay, in this case, this is for a whole year. So to find out our operating days in this case, we're open 6 days a week, and there's 52 weeks in a year. Okay? And that would be the math that we want to put together. So let's actually write this out in Excel. Times 15 times 6 times 52. And that should give us $16.16. So again, that's the math. Let's talk about what this means. Based on the fact that I have 20 seats and that they turn over 15 times and that I'm open 6 days a week for the whole year, okay, in order to make this revenue requirement, in order to sell this much money based on this information, I need to have an average check of $16.16. That's to meet this revenue requirement based on what usually happens in my restaurant. Okay? So with this information, we can start to make some pricing decisions. Okay? If your average check would be very hard to achieve based on the price that you have, you may have to increase it a bit. If it's higher your average check than this number, then you're in good position. Okay? If your price is already higher than this, you don't have to worry too much. You should achieve this $16.16 without any issues. Okay? But this would give us an overall look of the entire day. This restaurant, and let's go to example number 2, is likely open for at least 2 meals, but in this case we've got it open for 3 meals. Okay. And this is where we have to do just a bit of different calculation. It's still the same, but it's slightly different. Okay. Before we can find out the average check for each meal period. And why we do this, it will become quite evident in a bit, because 16.16, it's going to be very hard to achieve $16.16 at breakfast. At lunch we can probably achieve it, and at dinner we can probably achieve it. But we probably need even higher amounts here because we turn over our seats less. Okay, so let's go through an example. So in this case, we can open up our brackets. Okay, because we want to go our meal period sales revenue percentage. So in this example, we still need the revenue requirement of $1.5 million in order to get to our goal. And that's where this would have come from, right? Whoever put this together would have started from the bottom up and figured out their revenue requirement. Now that they know this, we can start to use it to find out even more information. So in this case, breakfast brings in 45% of the revenue, so 0.45. And we would multiply that by my required revenue for the whole year. Okay. What that's going to do is that's going to explain to me how much of that revenue will likely come from breakfast. Okay. And we're going to divide it by, we'll open up our brackets again. Okay. Now we still have 20 seats. Okay. The difference is that we want to use the seat turnover for this time of day, for this meal period. Not the 15 that we originally used, but breakfast turns over quicker, and this is true of most restaurants. So we multiply by 10 times because that's how many times seats turn over in this restaurant for breakfast, and we're going to do multiply by 6 multiplied by 52 again, okay? Because that's how many days we have. So we can make this bigger so you can see it. So if we do this in Excel, 0.545 times 2 and divided by our 20 times 10 times 6 times 52, close our brackets. We should see that we have an average check of $10.91 that's required in order to make 45% of this amount at breakfast based on the 10 seat turnovers. Okay? So now we can do the same here. So instead of 45%, 25%, my apologies, 25% of sales come from lunch. So what's 25% of our revenue requirement is what we need to know. We still have 20 seats in the restaurant, that doesn't change, but 25% of my revenues come from that. And then I'm open 6 days, 52 weeks a year. So now we can do the math using Excel, 0.25 multiplied by our required revenue divided by how many seats we have times, and I shouldn't have put 0.25, my apologies, it should be 3 times a day turnover times 6 times 52. So just over here, it should be 3. Okay? And what the 3 is the meal period seat turnover, not the 0.25. Okay? So using that information, I need $20.20 in average check at lunch in order to get this revenue requirement, based on the fact that only 25% of my revenues come from lunch and my seats only turn over 3 times. And then lastly, we would go 0.3%. Okay, so 30%, sorry, so 0.3 times my revenue requirement. And we divide that by how many seats we have times how many times they turn over during this meal period, which is 1.5, then times 6 times 52 days in a year. If we do that, 3 times my revenue requirement divided by 20 times 1.5 times 6 times 52. You'll see that I need a much higher average check at dinner, and that's because I'm not getting as much, well, I'm still getting more than lunch, but I only turn over 1.5 times. I turn over half the amount of times that I do at lunch, and even more, less than a quarter of the time, a fifth of the time that I do at dinner. Okay, so I'm going to need a higher average check at dinner in order to get this revenue requirement. And this revenue requirement will then help me get my net income after tax goal. Okay, so it kind of comes full circle. So what I now know is that my average check at breakfast needs to be $10.91. My lunch average check needs to be $20.20, and my dinner needs to be $48.47. So instead of the $16.16, you'll notice that it's quite different based on meal periods. Using this information, I can now look at my menu prices for breakfast, my menu prices at lunch, and my menu prices at dinner, and find out whether or not I can actually reach these goals. And if I can't, do I need to play with my pricing slightly in order to meet this revenue requirement? So, how do we increase the bottom line really at the end of the day? There's 4 different ways. We can increase prices. Okay, so that would just be the easiest way. Make more revenue because you have more prices, therefore you should make more profit. Remember the price-value relationship. You have to make sure that you're still offering value to your guests. We could decrease costs, okay, and that would be cheaper alternatives to your ingredients, reducing portion size, but again, make sure you're providing value for your guests. You could increase turnover, so make it so that service is quicker somehow. Make it so that your seats are used up more frequently, so that if they come in, have a quicker meal, you can serve that table again. Or somehow market it so you have more people coming into your restaurant. And an easier way as well is increasing operating days. So in the example we just looked at, that restaurant was only open 6 days a week. Well, why not open 7 days a week and make a bit more revenue, which could provide you with more profit? You could also look at being open for different meal periods. If you're only open for lunch and dinner, another way of making more revenue would be to open for breakfast as well. But you'd want to look at whether or not it would actually be worth your while cost-wise to do that. So that's your presentation on bottom-up approach and the restaurant bottom-up approach. Stay tuned for a video on your hotel bottom-up approach.